Hello, hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amanduri, and I'm joined today with David Jensen of SafeHaven.com. Yeah, we're going to be talking about what's going on in the economy and, where are the safe havens going forward here. And David is an expert on the markets. He's an expert on, geopolitics, and he really has a pulse for what is going on. He's been featured all over the internet and through major news outlets, and he's a real authority on the space. So I'm really excited to be talking to him today. David, thanks for coming on Crush the Street with me.
Good morning, Kath. It's a real pleasure to join you, and thanks for having me on.
David, I'd like to start off with your thoughts on the economy. It really does seem like things are feeling better. I mean, you listen to the Trump rally, the speeches, you hear about the billions of dollars coming back into the country. The wages are rising. There's a shortage of workers, and the unemployment rate is coming down. And everyone knows that I understand that a lot of these things are manipulated. But even with manipulation, we are trending, quote unquote, in the right direction on a lot of these optical measures here. So, I'd love to kind of get your thoughts on what is going on in the economy and, what are we missing?
Sure. Well, I guess first of all is rising rates portend a slowdown of liquidity to the markets, which you and I are discussing is a prerequisite for the markets. And just the Fed raising rates alone, I'm not sure if you saw the piece from Bank of America a couple of weeks ago showing that over the last several decades that the Fed has triggered crises at a lower and lower interest rate going forward as they raise rates, and that they're projecting at about a 3% rate now that we're going to have a crisis in the market. So that the markets certainly haven't responded in any kind of a rational fashion to the rising rates of the Fed. And I think, Ken, that there's a couple of other things going on behind the scenes and that look to me like they could trigger a correction in the markets. And one is not just rising rates, but rising oil prices. And you and I touched base here about that the won settled oil future going forward that started trading in China on March 26th. And really, we've seen a rising oil price going forward from last September when it was announced that this contract would start trading this springtime. And what's unique about the contract is that it's settled not just in won, but it offers a gold settlement aspect to it itself as well. And I've been posting quite a bit on Twitter when it first came out in April and May, saying that this would lead to a bifurcated or a split pricing system in the market, and ultimately a much higher US dollar oil price or euro oil price. If you can get settlement with an asset of intrinsic value like gold, it should logically result in a higher price if you're paying with something that's less attractive. And we've seen the oil price rising along with the interest rates over this period. It was about $50 last September, and it was about $75 now. And the first settlement, I don't know if I mentioned it, but it's in September coming up now. So that they're trading on the futures market, and the first contract settles in September. And Jörg Kiner, he was out last week with an interview on Bloomberg where he was saying that the oil price rise makes no sense when you look at the supply-demand balance. I haven't personally looked at, in great detail at the supply-demand balance, but it looks to be roughly in balance right now, and yet we've had a 50% rise up in the oil price over the last 7-8 months, and it's leaving a lot of people quite quizzical, curious as to why this would be going on. So what he's saying is that we are relentlessly moving higher in oil as we get closer to the September oil settlement, and then secondarily that it's going to have a material impact on the gold market because of the physical gold that it pulls out of the system.
So, David, I got a question then. Really, what does this say? Number one, it's to me, it says that there's some sort of a revaluation, maybe of oil that needs to happen, or there's some manipulation going on. And what does it say about the underlying economy? Does it speak to you know because of this, we know that what's going on in the US or the Western world is really deteriorating.
Yeah, well, I guess the key thing that I always go hark back to is that if we look at the way we calculate inflation, it's misrepresenting the true growth that we have. But there are ways that you can see it. If you look at the U.S., there's 94 million people not included in the labor force. It's up in round numbers around 20 million people from 10 years ago. And there's 42 million people on food stamps, up roughly 16 million from the level about 10 years ago. So there's been no real recovery that we can see. At the margins, things have been improving in the last 12 months, but because of the way we calculate inflation, when we look at that the growth that's calculated, it's really being misrepresented if we consider the true real value of the dollar. So I think that we've been in steady decline for more than a decade here in true real output. And it certainly shows up in places like the number of people that are employed and on food stamps in the States. So
Yeah.
I think that the higher interest rates and the higher oil prices with that kind of a backdrop are going to have a precipitous effect. And secondarily, on the gold price, or you mentioned manipulations, like the gold is priced in London. 90% of daily global trade is in London, using unbacked, unallocated certificates. And this Chinese move now to settle gold with settle oil with physical gold delivery, it's going to have a tremendous impact on the London market because it creates a price insensitive demand for gold, which doesn't respond to the whipping around of the digital gold price and the taking out of the stops of the traders, etc. You can't dissuade people from the gold market with trading action anymore if it's a medium of delivery, and that's the stress that this oil trade is going to be putting on the London market, and I think driving interest rates much higher, and then compounding back into an impact on ultimately on the real economy is where we started this discussion.
Yeah. Well, talking about the deterioration of purchasing power, something that I've been repeating here is you have this 30% decline of purchasing power of Social Security since 2000. And I mean, now today to start your life in 2018, meaning having to buy a house and get established, I mean, you got to be making what a doctor or a lawyer makes compared to, back in the 1960s or 70s. The same lifestyle could have been had as maybe a postal worker. And it
Yeah,
really goes to show that the decline of purchasing power of labor is really happening, and it's getting very, very difficult despite the numbers that people want to believe. it's
yeah,
it's not the same apples to apples if you look at the type of jobs that people had and the type of lifestyles that people are living, and then throw in the fact that way more families now have two people working
yep.
versus back then, one person, single worker households. That alone is a deterioration of lifestyle. Not,
There's been a real loss of wealth from the American economy over the last several decades, or really 3 or 4 decades, and it's really starting to show up now. You see it in many aspects, but I think much of it reverts back to the reserve currency status of the dollar, the ability to continually run deficits, and the requirement to export the dollar globally through trade deficits to provide liquidity for the use of the dollar in global trade. So that kind of hinges back on the second point that we were going to discuss in terms of the reserve currency status and the Triffin dilemma and what we're seeing now. Okay.
yeah, no, and I guess before we get to that, And maybe you can transition to this as you answer this question here is, we're talking about the tariffs.
Yeah.
You might have noticed, and regardless if you saw this latest news or not, but Tesla it decided to open up a plant in China.
Yeah.
They're supposed to have a capacity of 500,000 cars a year. I mean, I think in 2017, they didn't even make 100,000 cars. And, this plant is supposed to produce 500,000 at full capacity when it's up and running.
Yes.
And I'm wondering if this again is a result or an indirect result or direct result, or incentivized by the Trump tariffs, saying, hey, we're going to tariff goods that
Mm-hmm.
and so because of that, because of this trade war that we're seeing, uh, Elon Musk is saying, hey, we're going to actually build there, and sell directly to the people. Any thoughts on that, or just the tariffs in general?
Yeah. Well, the tariffs, the duties prior to them that have been in place. If you look at China as the example that you've selected, they were running duties on U.S. car imports between 18 and 25% prior to Trump raising the issue. And the Europeans, the duties on on U.S. cars imported to Europe are twice what the duties are of European cars imported into America. And so I think what's being done with these tariffs is a forceful leveling of the playing field. Like everybody typically wants to see free trade. But really, if you look at the balance sheet of the tariffs historically versus America, there was, as part of the Marshall Plan after World War II, there was favoritism expressed to Europe through trade that would allow them to rebuild their economy. And the duties that are in place were never were not balanced after a period of time, and they've been allowed to run. And really, Kenneth, in combination with the reserve currency status, which requires America to run a trade deficit to export the dollars. And this reverts to that Triffin dilemma that you and I were discussing. But the whole concept that when you have a reserve currency, you must run trade deficits, you must act against the interests of your own country to provide global liquidity. And so I think, to directly answer your question, the tariffs are being applied to level the trade playing field in a forceful manner. But there really is not much of an option at this point that I can see for America in terms of the steady degradation of the quality of life that you were mentioning earlier. And if we look at the concept of exporting or importing more goods than you export, you're ultimately exporting dollars, but you're also exporting jobs to the tune, in round numbers, of about $500 billion a year. And so the US, when they have 94 million people not in the labor force and 42 million people on food stamps, you're up against now the limits of what you can tolerate, without destabilizing your country. And so,
David, let me just jump in right there. I'm sympathetic to these tariffs, even though from a strictly a libertarian or Austrian economist perspective, free trade is better. We all agree on that. But I think the chess game, this high level 3-dimensional chess game that Trump is playing, a lot of this is posturing. I don't necessarily believe that he wants to have a trade war or he wants to have tariffs, but I think what he's doing is trying to get concessions and saying, hey, let's fix some of these things that are imbalanced in favor of maybe other countries. And by bringing these things up, maybe the U.S. is positioned better down the road. Is that something? Would you agree with that?
Yeah, to some extent, but I think that there's been the chronic trade deficits and the chronic exporting of jobs, I think, is his focus. I think that is his true intent. But parenthetically, what's not being said here is that if he balances trade, or even moves in a material fashion towards balanced trade in reducing the deficit, there's going to be a US dollar liquidity crisis. And ultimately, there's going to be a stand down of the US dollar as the global reserve currency. That those go hand in hand. And I don't think that President Trump has much choice right now, given that you've got such elevated levels of the unemployed. If we use the unemployment measure from 1990, unemployment in the States is 21.5%. Everybody's saying 3.8%, fantastic. But what if you haven't applied actively for a job in the last 2 weeks, you're no longer considered in the labor force, and therefore you're not considered unemployed. So I think that behind the numbers, there are numbers advertising that there's an economic and increasing crisis going on. And the fact that it's not just posturing, I think that there's a scramble now to kickstart activity in the United States before the next recession, because the numbers are already elevated in terms of people that aren't productively engaged in the economy. And if you have a step down now in those numbers going into a recession, then you've got a real crisis on your hands. So I do think that what he's doing is real. But I think that for me, the really curious aspect, or the most intriguing aspect about this, is that if you reduce the trade deficit in a material fashion, there's a US dollar crisis going to be kicked off in terms of liquidity loss globally, because you're no longer exporting dollars the way that you had been. And that feeds into the other point that we were discussing in terms of the evidence of a banking crisis that's now kicking off in China. I think because of rising US dollar, the DXY, also rising interest rates, and now the signal from the Trump administration that they are applying tariffs and that they do want to see balanced trade, and it appears to be kicking something off in China, whose domestic banks are greatly offside the US dollar.
Yeah. Well, let's talk about gold. I think everyone has been disheartened over since 2011, for one reason or another. We had an exciting 2016. We came off of the rate hikes, and we really saw a reversal, I guess, as of this last rate hike, where, since December of 2015, rate hike to rate hike, we've seen gold actually go up. And this last time around, we actually saw a major reversal of that following the rate hike. So I think people are a little bit frustrated with gold because we're not really seeing it go up in a very decisive way. And the longer this goes on, I feel like the more of a confirmation to the upside people are going to need to have to believe that a bull market is in place. So, David, if you could just speak to this, or just kind of your thoughts on where we are with gold, that would be very helpful.
Well, I think that the biggest challenge in trying to draw any information from the gold price is the structure of the market itself and how the asset is priced. And the way that I look at the market now is that it's more advertisement than price discovery. When I look at the trading, the 90% of global turnover in gold trading is in London on the LBMA on a daily basis. They're trading 220 million ounces of unallocated contracts. So they're just debt instruments. They're gold debt instruments. And if you look at the COMEX, which is about another 5% of global trade, their gold settlement on a turnover basis, or on a contract basis, pardon me, is about 0.04%. So what we're really looking at here is signals that are not representing gold. They're really a fictional gold market. So there's a physical market which is really threatened by this gold settlement for oil, because in London, when you don't have adequate inventory, you've got to have flow of metal. And the challenge here is that the demand for gold on that limited flow from the miners are really providing an appearance of respectability to London by selling their metal through the London facility. And the demand for physical gold that's going to come now with a small amount of China's oil pulling that gold out of London is going to break down that digital pricing structure. So I don't really, I've gotten to the point now where I ignore all the price analysis on the gold market, because the price discovery is not reflecting supply and demand for the physical metal. And I think that's the game changer that we have coming here. And I think it's going to be two things that are going to drive a change and a repricing of gold starting really in September, Kenneth, with the settlement of the oil contract in Shanghai. But there's that aspect, and also the fact that I think that there's this bank panic that I alluded to in China appears to be kicking off. And it's due to the fact, by the way, Jeffrey Snyder of Alhambra Partners wrote an article where he pointed out that the Chinese domestic banks have borrowed $2 trillion in US dollars from the interbank, offshore interbank market, primarily on that market. And that now, with the rising interest rates from the Fed and the rising dollar index, and the signal from the American administration that they're going to be applying tariffs and cutting off further dollar liquidity, it's starting a Chinese yuan panic. A week ago, the Chinese central bank had to intervene and say everybody should remain calm, and that there was things were under control after the yuan lost 1% in a 24-hour period. But that's in the backdrop there as well, and I think that's going to be impacting the gold market as well going forward, because what you have now is China with reserves. David Stockman was pointing out that the reserves of China versus their broad money stock is less than Thailand had going into the bot crisis. They're only about 10% of reserves versus the broad money stock. And as people are selling yuan and buying US dollars, they're driving down the value of the yuan. And because it's a $2 trillion number to begin with, it's beyond the scope of the Chinese central bank to deal with. So I see that as a second potential trigger here in terms of the price of gold ultimately, because it may force China's hand, if there's a great crisis, to revert to some other unit of exchange. I think they already are heading in that direction, but I think that this growing stress in China, with the central bank now having to go public and intervene, could be another trigger to a new pricing structure for gold. But really, I find it so frustrating to try and follow gold and anticipate any change, because, as you note, the gold is not really behaving in a fashion which appears to be coherent given the other things that we're seeing in the market.
David, that's powerful. And again, let's reiterate kind of what you're expecting in September. I mean, that's kind of a significant thing that, is on the horizon here. And, I'm so frustrated with what's been going on with the manipulation now. And it's just been a constant just train wreck when you watch the way, these metal prices have been manipulated. And, it would be really powerful to see something disrupt what is going on in the gold markets, and really reward the people who, hold physical metal, and the miners who are now having to sell the metals at such depressed prices, and because of market manipulation, right? That's what market manipulation, and many people are suffering because of it. So maybe reiterate that, and just give us some closing thoughts as we close out this interview.
Yeah, no, I think it's coming, Kenneth, in terms of the United States, America can't tolerate these trade deficits anymore, because it's gutting the country. There's a large number of people who have been parked out of the economy, number one. So there is the aspect of the stand down in the reserve currency status, which is implied by tariffs on trade and balancing of trade. If you're not running a large trade deficit to provide dollar liquidity, your dollar cannot be a reserve currency anymore. So if your dollar is not the reserve currency used for a settlement of trade, then what is? And it's a very, very short list. And I really see only one thing on the list personally, but that may be my own bias. And then secondly, the oil settlement, the trade of oil with settlement in gold in China, I think is going to stress the paper markets. And the number one paper market, or the number one gold market in the world, in the Western world has been London, and this relentless pull of gold. When you're settling gold for oil, um, settling, making payment with gold for oil, and keeping in mind that the daily mining of gold from global mines is 1/20th in terms of the dollar value of the oil that's produced. You only need 5% of the global oil trade to settle in gold, and you're going to disrupt that market. And the market that's been run in London has been one of continual flows through with almost no inventory backing it up. And by the way, I always chuckle thinking about Rob McEwen when he was running Goldcorp, because what he was doing at that time was he was holding back gold supply from the gold miner when he saw the price drop. And that must have caused real panic in the London market, because they need this continual flow of gold from the miners to give the London market an appearance of a real market. So the stress now that's being applied, that's going to be applied in September when the gold starts to be pulled on a price insensitive basis. It's just, if you're receiving oil and they want gold, you've got to give them gold. So it's going to break the paper pricing structure of that market, maybe not right away, but sequentially with time, it's going to just continue to compound to the point that you've got to have a new market with a new pricing system based on real exchange and price discovery of supply and demand for the physical metal. And I think it's going to be going live in September. And I think we are seeing it in the price of oil to some extent, because the $75, and today, for instance, the price of oil is up and the US dollar is strengthened. And so, we're not seeing any input there that would explain the increase in the price of oil. And it's a frequent artifact of the markets that there appears to be something else other than supply and demand for oil that's driving the price up. And I think this new settlement mechanism is going to make oil much more expensive when you're paying for paper in the future. And it's going to restructure the global gold market in terms of price discovery.
Powerful words there. All right, everybody. This was David Jensen of safehaven.com. David, if you would, share a little bit about your website and what people can find if they...
Safe Haven isn't my website. It's where I've posted articles over the years. And more than a decade ago, I sent two letters to David Dodge of the Bank of Canada about a year before the financial crisis. I had met him here in Vancouver as a former professor of mine when he was speaking. And so there's about 30 articles there that I've posted on the web through Safe Haven over the years. I'm also posting frequently with these thoughts on gold and oil on Twitter, and my Twitter handle is Real David Jensen. So Real, no space David, no space Jensen, Jensen, and so I post my thoughts there as well, Kenneth.
All right, sir. Well, hey, I appreciate you coming on Crush the Street with me today. Thanks so much for your time.
My pleasure. Thank you, Kenneth.